I am honored getting the opportunity to talk to Padma Vibhushan Professor Y.V. Reddy, former Governor of Reserve Bank of India. Sir, first of all, on behalf of NewsClick as well as on behalf of Network Ideas, many congratulations. My first question is, after the financial crisis, in fact, many economists are arguing for having more regulation on the banking system. What kind of regulation should we do away with, and what kind of regulation should we, uh, impose?
See, let us see the issue of regulation. At the moment, the whole debate about changing the regulatory structures is concentrated in USA, UK and Europe. So, there were particular models of regulation, and it is now after the crisis it is recognized that that did not work, in the sense that it resulted in serious instability, and the so called liberalization and financial innovation had overtaken to an extent that while their contribution to economic development is not clear, their contribution to instability is very clear. Therefore, there is a relook at what should be done. So, at the moment I would say that there is no definite wisdom as to what should be the new regulatory structure, but the old regulatory structure does not help. Now, let me come to the preliminary understanding there. There the preliminary understanding is that banks, which the traditional type of banking, should be special, it should be treated specially. Second, banks doing non-traditional type of banking activity may be risky, additional capital should be provided for, and anti-cyclical or pro-cyclicality should be removed, and counter-cyclical measures should be there. And individual banks alone, if each individual bank is all right or sound, it does not necessarily lead to systemic stability. So, macroprudential is required. There is a consensus on that. From our point of view, we are not starting from that highly deregulated, highly sophisticated, dangerous system. Exactly. So, therefore, we are at a different level. But there are a couple of things which very clearly come out as a lesson from this crisis, which should be relevant for countries like India. One, we should not certainly rush into the deregulation of the old model, definitely not. It is better to take a pause. Second, that we should maintain the integrity of the banks. In other words, let us not encourage banks, which we have been doing, at least attempting to do, go into private funds, equity funds, etc., etc. Third, the traditional view that public ownership is always bad is not correct. There can be public ownership, there can be private ownership, there can be combined ownership. But more important is governance has failed in the banks, in the financial institutions, in other countries. So, we have to emphasize ownership and governance. That is a part of regulation. And as regards to most important thing is the development objective should be incorporated in the banking regulation. Not only stability, you see, one is the stability, financial stability, where the Western the reforms are concentrating on issue of stability. In my view, it is a question of stability, protection of depositors' money, and the third important is how does it contribute to development in a broader sense.
As you have already mentioned that this re-regulation or some kind of orientation or not only stability but also financial inclusion. In this context, what is the basic difference between government owned bank and private owned?
Okay, actually in terms of the regulatory regime is concerned, the totality of the regulatory regime in India, and I presume that will be normal in most of the cases, the banking regulation is common, whether it is private or public. The governance may be different. The governance, because in a public sector bank there is greater accountability. Thirdly, the priorities of owner. In the case of government bank, government is the owner. Their priorities may be different. But otherwise, pure financial regulation as a regulator, at least in India, and I believe it is so in other countries, it does not make a distinction between private and public. But the point that is made is there are two things that happen that now in retrospect, there is an advantage of public sector banks. Second, the first is that banking is a business of trust, and people in the ultimate analysis trust the government banks. Second, if the government is doing banking business and if there are public sector banks, the public policy has an intimate knowledge of banking industry. When the public policy has intimate knowledge of banking industry, the information asymmetry for the regulator is less.
Absolutely.
And therefore, your effectiveness of regulation improves, and your capacity to adjust the system by increasing or decreasing, because you have an instrument. There is a public policy instrument in the banking industry which you can use, and the rest of the private sector bank knows that there is a public sector bank. So, it is like a countervailing power, like an alternative opportunity for public policy. So, in a way, therefore, I would say that there should be a better recognition of a role of public sector banks as enhancing the totality of the banking stability and the totality of the effectiveness of regulation. That should be a new dynamic we should consider. It is not either or. And more so, particularly in advanced countries, they have injected so much capital, virtually majority of the capital. So, this is an opportunity for the government to say, I have injected majority capital, I will continue there, I will get better knowledge of the banking industry, and that will be a counter. If any other private bank is not doing well, we can merge it. They do not have these options. That is why the whole system had to collapse.
Sir, regarding inflation, whenever inflation is higher, the central banks all around the world, following Taylor's rule, they try to increase interest rate, and by increasing interest rate, they try to curb the demand. Whether real purchasing power of people would remain intact or go down or go up is not unambiguous.
See, let us first at a very extreme level, if printed money and low interest rate were to bring about growth without risk, no country will be poor. So, there is a trade off. I think first we should recognize. Second, any price increase of an individual commodity is a reflection of supply and demand at any point of time.
Right.
So, what we are talking of is the generalized increase in prices. But when you say about oil or supply side, we have to distinguish between a generalized problem of supply bottlenecks, etc., which again, if there is a supply bottleneck, the only way you can maintain prices is to constrain the demand or increase the supply. If you allow both of them to, if you do not handle either, if those who supply management cannot produce enhanced supply, and if you allow the demand to continue, then definitely it will increase in prices. So, what you are really referring to is the role of monetary policy in the context of shocks, like oil shock or externally induced. Now, then we have to go into the definition of a shock. Definition of a shock is something which is temporary, which will go back to where it was. That is a judgment that the monetary authority has to make, and the monetary authority should be able to convince the people that it is temporary. It is a shock, therefore, I am ignoring it. You also ignore it, then there will be no impact on inflation expectations. But if you do not know in advance whether it is a shock or a structural shift in prices, now what risk should you take? Should you assume that it is a shock, or should you assume that it is not a shock, and what type of judgments you make? That is the most important thing. The more important thing is that you have to be symmetrical in terms of expectations. My point is, while you can look at growth sentiment, so that whenever, for instance, if there is a problem, you say that because of growth sentiment, you must reduce the interest rate, even if it is not going to be reflected anywhere. But the same thing applies to inflation. You have to curb inflation expectations, which may require actions rather than studied silence. So, it is a question of a judgment, it is a question of expectations, but one has to be very clear that A, whether it is a shock or not, and B, how it is influencing expectations. With reference to this, you keep the more fundamental balance between savings and investment and demand and supply. So, my suggestion is it is contextual.
It is quite long that this debate is going on for full capital account convertibility, whether particularly after financial crisis, when people say that of course, you have also said that given the developments, recent developments, your policy decisions would be more national and less global. At national level, we should have some restrictions, regulations or whatever. In this context, particularly after financial crisis, what is your opinion regarding full capital account convertibility?
I will put it two different ways. One is the issue of capital account convertibility in general, and second is the issue of policy space. On the issue of capital account convertibility, as I always said, there is no evidence to show that global flow of capitals up and down have served the original purpose. They are supposed to finance development of underdeveloped countries. What have they done? They have financed the consumption of America from the developed. So, and even if you take allocation of resources, efficient. So, it is a question mark. I am not saying, but it is not proven either way. Secondly, if you look at the Indian situation, the capital, when a foreign capital is coming, it is meant to supplement the capital, but how about the domestic real market, real economy and domestic financial economy? Both of them should be market based. If the domestic real economy is not market based, if the domestic financial market and the domestic fiscal policy is not responsible, very responsible, then there are distortions in the domestic economy. If the foreign capital comes, how is it going to add to efficient allocation of resources if there are inherent policy distortions? So, if you want to get the maximum advantage of capital flows, external capital or for that matter domestic capital, you must have adequate development of institutions and markets. So, therefore, we keep saying there should be preconditions, many things should be done to get maximum advantage and minimize risk.